Welcome to the Deep Dive. Imagine a company just hitting record revenues, really pushing towards profitability, but also, navigating this high-stakes game of regulatory chess. That's pretty much the story of DraftKings Q2 2025 earnings call. We're going to break down how they manage this balancing act.
Yeah, and what it really means for the future of online gaming.
Exactly. We want to give you the clearest picture without you having to wade through hours of investor calls.
It really was a fascinating quarter. Some interesting dynamics under the surface. DraftKings is clearly, evolving its strategy.
Right.
And while we saw this record performance, which was impressive, there were also some subtle market reactions. They tell a bit of a broader story, I think.
Absolutely. So today, we'll walk you through the key figures, definitely get into what management was saying, and look at what it all implies for where the company's heading.
Especially with that regulatory landscape just constantly shifting.
It keeps changing. We want to make sure you walk away really understanding the picture. Okay, let's dive right into the numbers because honestly, they are pretty compelling.
Yep.
DraftKings put up a really strong second quarter. Record revenue, record Adjusted EBITDA, significantly beating the consensus estimates pretty much everywhere.
Indeed. If you look at their GAAP EPS, that's earnings per share by standard accounting rules, came in strong at 0.30 cents. That beat the consensus by a full $1.15.
Wow, double.
Yeah. And maybe even more striking, the Adjusted EBITDA, which is, a key measure of their operational profit before certain expenses hit $301 million.
$300 million.
Which works out to about a 19.9% margin. That's effectively double their previous record. It really signals a strong, deliberate move towards actual sustained profitability.
And the top line, the revenue, wasn't exactly lagging either.
Not at all.
It surged to $1.513 billion. That just blew past the $1.42 billion consensus. Yeah. It's a huge 36.9% year-over-year increase. I think the company actually called it 37% growth.
Right, basically 37%.
And on the customer side, monthly unique payers, or MUPs, they saw a 6% year-over-year bump to 3.3 million. But what's really interesting, I think, is the average revenue per MUP, the ARPMUP.
That surged.
Yeah, surged by 29% to 151 rolls.
And that ARPMUP growth, that's really a critical piece here. Now, initially, the market reaction was quite positive, right? Saw these headline numbers.
It was popped pre-market, didn't they?
Yeah, over 2% up pre-market. But then that enthusiasm kind of cooled off a bit by the next day's close, ended down slightly, about 0.4%.
Interesting. So what does that tell you?
Well, it suggests investors were maybe digging a bit deeper, absorbing the full picture, perhaps looking closely at how the company's positioning for those near-term regulatory things we mentioned, and maybe some of the tax overhangs we'll get into. It's a nuanced reaction, strong report, but maybe some caution baked in.
Okay, let's really unpack this quarter then, because the details, they really paint the picture. CEO Jason Robbins was highlighting record revenue, net income, Adjusted EBITDA. But what specific drivers within that accelerating 37% revenue growth do you think really point towards DraftKings' future?
That's the key question, isn't it? What's really fascinating are the underlying drivers that speak to more sustainable structural improvements.
Right.
Just look at sportsbook revenue alone. It jumped a massive 45% year over year, almost $1 billion, $998 million.
45%.
And their net revenue margins hit a record 8.7%. Now, this wasn't just luck or favorable outcomes, though that helped. It was substantially boosted by a 100 basis point increase in what they call structural sportsbook hold.
Okay, hold on. Basis point, that's 1/100%, right?
Okay.
For listeners not familiar.
Just a tiny fraction. But when you're talking billions in revenue, 100 basis points or a full 1% increase in hold is significant.
And what exactly is structural sportsbook hold? Why did it jump so much?
Good question. So structural hold is basically the inherent mathematical edge the sportsbook builds into its odds and its offerings. It's how they make money reliably over time.
Okay.
That 100 basis point increase means they've just gotten better, more efficient at optimizing their product. And a key reason for that, they said, was a 430 basis point increase in parlay mix.
Ah, parlays.
Yes. Parlays combine multiple bets into one wager. They're riskier for the bettor, but much more profitable for the sportsbook. So seeing more people choose parlays, that 4.3 percentage point jump in mix, That's a big deal for their bottom line. It's kind of the golden goose.
So it sounds like they're getting smarter about pricing, about the products they're pushing. And didn't they also mention some help from sportsbook-friendly outcomes?
They did, yeah. In May and June, favorable results added about $110 million to revenue, so that helped too.
Okay, so a mix of skill and maybe a little luck there.
A bit of both.
Yeah.
But importantly, their promotional reinvestment also improved by nearly 600 basis points. That shows they're getting more efficient at keeping customers without, just giving away free bets constantly.
Right, not giving away the farm.
Exactly.
Yeah.
And then there's iGaming, which is increasingly important, online casino stuff. Net revenue there was up 23% year over year.
Solid.
Yeah, supported by strong growth in active iGaming customers and, interestingly, a 100% year over year jump in Jackpocket gross gaming revenue. That's their lottery courier service.
Right, the acquisition paying off there.
Seems like it. And the overall adjusted gross margin across the whole business expanded to 48%. That's up more than 400 basis points year over year. It just clearly reflects that better hold we talked about and that better promotional efficiency. It's a holistic improvement.
Okay, with all these impressive numbers, you naturally start to wonder, is this sustainable? What does it mean for their outlook? Management reiterated their full year 2025 guidance, right?
They did, aiming for the high end of their revenue range. That's $6.2 to $6.4 billion, and near the midpoint for Adjusted EBITDA, which is $800 million to $900 million.
And that guidance now includes some headwinds, doesn't it?
Yes, and that's significant. It now explicitly factors in two big things. One, the expected mobile sportsbook launch in Missouri, which is a positive.
Yeah.
And two, the financial hit from higher tax rates that just kicked in places like New Jersey, Louisiana, and Illinois.
All right, those tax hikes are a big deal.
They are. The company also indicated they now expect their sportsbook revenue margin to actually exceed 7.5%. That's an upgrade from their prior range of 7% to 7.5%. So that's a pretty strong vote of confidence in their own operational improvements, despite the tax pressure.
That is a strong signal. But let me play devil's advocate for a second. How much of this momentum do you think really comes from those temporary things, like the friendly outcomes versus fundamental shifts that are going to last?
That's a really critical point to consider, absolutely. And while those favorable outcomes definitely gave them a nice bump this quarter, management was also really hammering home the structural changes that increased hold, the higher parlay mix. These are, deliberate strategic moves they're making.
Right.
And the fact that their improved guidance includes those future headwinds like higher taxes suggests they believe their operational efficiency gains can actually overcome some of those challenges. It's a fascinating tightrope walk, isn't it?
It really is. Balancing that aggressive growth push with these regulatory hurdles popping up everywhere.
Yeah.
And speaking of hurdles, that brings us to Illinois. DraftKings made a really unprecedented move there, announcing a dealer $1.50 per wager surcharge on mobile and online bets. Starts September 1st.
Yeah.
They're calling it a pass-through to protect margins. But it's the first time we've seen anything like this in the industry. What does this experiment, as they called it, tell us?
This Illinois surcharge, it's more than just about Illinois margins. It really is a critical real-time experiment for the whole industry. Well, think about it. If DraftKings can actually pass this cost directly on to bettors without seeing a huge drop-off in players or losing significant market share,
Right.
it could fundamentally rewrite the playbook for how operators deal with rising state taxes everywhere. Imagine the implications. It might empower them to stay profitable, even in states that get really aggressive with taxes. That would be a huge shift in the power dynamic between the states and the operators. Definitely something to watch closely.
Fascinating. So if this works, we could see copycats in other high-tax states.
Potentially, yes. It sets a precedent.
Okay. Beyond Illinois, what other future initiatives did management talk about? Missouri came up.
Right. Post-call, they announced they secured that direct mobile betting license in Missouri. Excellent timing, just before the NFL season kicks off.
Huge market.
Huge. They expected to add about $35 to $45 million in EBITDA just this year. So that's a nice boost. What's also quite intriguing is they teased a potential prediction markets product.
Prediction markets, what's that?
Think betting on things beyond sports. Maybe political outcomes, financial market movements, that sort of thing.
Yeah.
Leveraging their existing platform and liquidity.
Interesting.
Yeah, but they're being cautious. They said they're in monitor mode. They know they need to consider regulators, other stakeholders. And crucially, the FY25 guidance does not include a launch for this yet.
So this prediction markets idea, could that tap into a whole different kind of betting psychology? Moving beyond just sports to Like you said, forecasting real-world events,
Right.
basically creating a whole new revenue stream.
Precisely. It could absolutely open up entirely new ways for people to engage on their platform. Think less traditional sports betting, more about forecasting, outcomes of various real-world events.
Yeah.
It has the potential to really expand their total addressable market. But as you can imagine, it also comes with potentially higher regulatory hurdles, right? Given the sensitive nature of some things you could bet on.
With politics especially.
Exactly. So their monitor mode stance is smart. They're carefully checking the regulatory and public waters before diving in. It feels like a longer-term play, but definitely one with potentially huge upside if they navigate it right.
And on the tech side, AI was a big focus too, wasn't it?
Oh yeah, huge focus. They see big opportunities to use AI to streamline costs. Things like renegotiating older state market access deals, making payment processing more efficient, cutting cloud service expenses. Standard stuff, but important.
But also top-line driving AI initiatives.
Yes, and this is where it gets interesting. They mentioned a handful of initiatives over the next 6-12 months aimed at boosting revenue, especially in their trading operations, setting odds, and managing risk.
So what does that look like specifically?
Well, what's insightful here is how they're sequencing it. They're focusing on the cost savings first, before really leaning into the big top-line AI pushes. That suggests a pretty mature, profit-focused approach, not just chasing AI hype.
Right. So
When they talk about top-line driving AI in trading, it could be anything from, say, dynamic real-time odds adjustments based on how a game is unfolding and where the bets are coming in,
okay.
to maybe hyper-personalized betting suggestions based on your past behavior, or even using AI for better fraud detection, which improves the experience and cuts costs. These aren't just small tweaks. They could be foundational shifts that build a real competitive advantage, even if they haven't put numbers on it in the guidance yet.
So it's about efficiency, but also subtly making the product stickier and smarter.
Exactly.
And speaking of the user experience, live betting is still a huge growth engine for them. Handle up 16% year over year, especially in baseball, apparently.
That's right. And think about why live betting is exploding. It's almost like being at the game, but with your phone, making split-second decisions on what happens next.
Yeah, that instant gratification.
Totally. DraftKings is clearly tapping into that, especially in sports like baseball, where there's constant action, pitch by pitch. They highlighted their platform's uptime, being reliable, and having wider offerings in those live markets.
Makes sense.
And they believe that personalization within the app, plus the fact that live betting opens up this longer window to acquire customers during a game, not just before it. That's going to keep bringing in new types of bettors, people who maybe aren't into pregame wagers but love that dynamic in-the-moment action. It's clever.
Okay, so connecting all these threads, if we zoom out to the bigger picture, it really feels like DraftKings' strategic pivot is working. Moving away from that old land grab at any cost mentality
Right.
towards a focus on profitable scale. The big beats on EPS and Adjusted EBITDA, strong revenue, that impressive ARPMUP growth, it all points to their improved hold and better promotional spending paying off.
Indeed. And while, yes, the monthly unique payer growth was maybe a bit softer than some analysts hoped for, partly due to losing Jackpocket in Texas from the comparison period, the clear focus now is on getting more value from existing customers and those optimization initiatives. That points towards a more sustainable and ultimately probably a more valuable growth path long term.
Plus, they bought back shares, right?
Yeah, 6.5 million shares repurchased year to date. That signals increasing confidence in their cash flow and a willingness to return capital to shareholders. That's a positive sign.
And their approach to regulation, like that Illinois surcharge,
Yeah.
it seems pragmatic. Defend margins, but stay in the market. And getting that Missouri license just before NFL season, that's a clear win.
Definitely a significant positive. Expands the footprint at a crucial time. Long term, the story is absolutely shifting towards profitable scale turning into durable cash generation. That's the narrative now.
So beyond the immediate numbers, we're looking at things like renegotiating market access deals, using AI more, maybe launching prediction markets.
Those are the key future catalysts. Exactly. But, and it's a big but, those varying state tax policies, that's going to remain the key swing factor. It creates this environment of constant regulatory change that they just have to keep navigating state by state. Agility is key.
All right, listeners, buckle up. It's time for our This Is Not Financial Advice segment. Now, especially for those of you who are maybe more experienced investors, we're going to toss around some hypothetical, maybe slightly out there trade ideas.
It's brainstorming, really.
Exactly. For anyone less familiar with options, Just think of these as thought experiments, ways to think about potential market reactions and future catalysts, absolutely not recommendations, purely for discussion and entertainment.
Right. And given they're looking at maybe $750 million in free cash flow for FY25, plus the share buybacks, there's some interesting optionality to think about.
Okay, here's trade idea one, the AI margin expansion vertical call spread.
Catchy name.
The thesis here is basically the market is seriously underestimating management's push into AI, both for cutting costs and eventually boosting the top line through things like trading. They literally said they're just scratching the surface now and see big unlocks over the next several years. So imagine AI driving, say, an extra 100, 200 basis points of EBITDA margin beyond what's guided, plus maybe some unexpected revenue lift from AI-powered personalization in live betting.
Okay, so how would you structure that trade idea?
Well, you could build a bullish vertical call spread that targets significant upside, maybe over the next 12, 18 months.
So for listeners, that's an option strategy. You buy one call option and sell another further out of the money call at the same time. It limits your potential profit, but also limits your risk.
Exactly, defined risk.
Right.
So maybe you buy, say, a $60 strike call option expiring maybe December 2026, and at the same time, you sell a higher strike call, maybe an $80 strike, to help pay for the first one.
Right. So this structure banks on a strong belief that management really delivers on that AI execution, hitting those big unlocks and pushing the stock price up significantly, but within that defined range.
Precisely. It's a way to play for significant upside based on that AI thesis without unlimited risk. Okay. Trade idea two, the Missouri Momentum event-driven put sell. This one's a bit more tactical, shorter term maybe.
Okay.
The idea is Missouri launches mobile betting in early December, right in the middle of peak NFL and NBA season.
Prime time.
Prime time. And management expects an accelerated curve for customer acquisition there because of the timing and maybe some pent-up demand. So there's a potential catalyst there for outperformance.
So how would you play that event?
Conceptually, you could consider selling a slightly out-of-the-money put option, maybe expiring early next year, say Q1 2026.
Yeah.
Perhaps around a $40 strike price.
Selling a put. So you collect premium upfront, right? And you're essentially betting the stock price won't fall below that strike price by expiration.
Exactly. The premium you collect would hopefully be attractive. And you're banking on that strong early performance in Missouri. Really efficient customer acquisition, low CAC, cost to acquire a customer.
Right. They mentioned expecting fantastic CAC right smack in the middle of NFL NBA.
Yeah, that strong launch could provide a nice floor under the stock price, especially if those initial Missouri numbers beat expectations. So this trade leverages that specific near-term event catalyst of a well-timed state launch.
Interesting. Different ways to think about the potential scenarios?
In summary then, DraftKings really did deliver a record-setting quarter. You see that accelerating revenue growth, clear strides towards profitable scale. Now, obviously, regulatory headwinds, maybe softer MUP growth, those things need watching. Yeah. But the company's strategic focus on monetization, getting efficient operationally, expanding into new markets, it provides a pretty strong foundation, it seems.
Yeah, I agree. We'll definitely be watching the impact of that Illinois surcharge. Is it working? How's the Missouri launch actually playing out? And what happens next with prediction markets and AI integration? That shift towards durable cash generation is really the key theme to monitor going forward.
Especially how they keep balancing that drive for innovation with this really complex state-by-state regulatory world.
It's a constant balancing act.
Okay, please remember, everyone, the insights we share here on the Deep Dive are purely for informational purposes. They're absolutely not financial advice. Always do your own research, your own due diligence, and please consult with a qualified financial professional before making any investment decisions.
Absolutely.
So as we wrap up this deep dive on DraftKings, here's a thought to leave you with. In this industry, increasingly shaped by tech arms races on one side and these shifting regulatory sands on the other, who wins in the end? Is it the company with the absolute best AI, or the one that's just most skilled at navigating the political currents state by state? Which force do you think ultimately shapes the future of online betting?
Good question to ponder.
We appreciate you tuning in, and we look forward to hearing your thoughts on our next deep dive.